Couple of them. First off, corn prices at two-year highs. Worries about an expanding Midwest drought helping to perpetuate that. And then in the citrus industry, a labor shortage may put even more of a squeeze on already tight supplies of orange juice. Joining us, Kevin Kerr, editor of Resource Trader Alert, and Louise Gardner, analyst from Spectrum Commodities. I welcome you both. Let's start with corn. Widespread knowledge of corn demand going up, Kevin, as a result of ethanol. Educate us on the impact of the drought and how much that is adding, and whether people should buy corn on speculation its price will go higher for those two reasons.
Well, absolutely. We are long corn and orange juice for both of the reasons that we've talked about earlier. Corn is facing not only drought, but heat this week is the big factor that's been driving prices. There was a report that temperatures this week are supposed to soar, and the heat alone could be a big factor of the crop that's already in the ground.
If you were to look at the two of them, Louise, corn and orange juice, which of the two do you believe is more vulnerable to a sell-off right now, if some of these sort of tension factors don't sustain themselves?
Well, we're in the beginning stages of drought reaction in the western Midwest in the corn prices. We've had a significant drop, actually, just a few weeks ago, and we're starting to rebuild that price structure, getting very close to those highs that were put in just a few weeks ago. So, I think we're in if the drought does not continue and the rains come and the heat subsides, I think the market will be done, and you'll falter from here. However, we're at the very beginning stages of a very energetic price move. So if the drought does continue and does persist, especially into the Midwest, you'll see prices become very volatile and very energetic, very powerful to the upside.
If you were to look at the orange juice picture, it's different than the corn picture is a lack of demand and an environmental concern. We've got more than enough oranges, Kevin. We just don't have enough people to pick them.
Well, that's true. We do have a good orange crop at the moment, but we are facing another hurricane season. We're not really deep into it yet. Right now, the concern, though, is that we have all these oranges on the trees that need to get picked, and we have about 9 million boxes left on the trees at this moment. And the workers, like you said, have been fleeing since last October, and now here we are in July, and they're having a lot of trouble finding people to do that job.
Why have workers been fleeing since last October?
Well, there's word that it may be on fear of the immigration crackdown. It also, I think, has to do with the weather last year just drove a lot of people away that don't want to take the chance of living in the hurricane belt once again this year and have left. And there's simply no workers to replace them.
Now, Louise, if somebody wanted to buy either corn or orange juice, futures, or participate in some way by being long corn or orange juice, what is the simplest way to do that without having to buy an orange grove to hedge my position?
Well, the simplest way is to participate in the futures market itself, and you can do that with futures contracts or the options on the futures contracts. That's the leverage offered by futures trading certainly gives somebody that opportunity to participate, obviously without having to be a producer or a user or own the physical product.
All right, listen, thank you both for your time. Kevin Kerr, Louise Gardner. We have 40 minutes to wrap up the trading day. Dow Jones Industrial Average trying to pick up a little bit of what it lost here. 20 points now the advance, Maria. The NASDAQ continues to be weak, though.
Get ready for some street smarts. That's up next. We'll be talking with one top mutual fund manager, which stocks he finds attractive and which investors might want to avoid at this point.
And then it'll be time to stop trading. Mad Money.